Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. Let's kick off this episode with an article from Bloomberg. Short sellers see $80 billion hit as November rally upends bets. Wagers against stocks produce worse losses since January, according to S3 Partners. Need to close money-losing positions may have fanned rally. According to that chart on the right, it looks like energy was the only winning sector for the shorts in November. Yeah, my ass bleeds for you guys. From the article, it was a brutal month for those betting against the U.S. stock market. Short sellers were caught flat-footed as the S&P 500 index roared back from a 3-month slump with the strongest gain since July of 2022, hammering them with mark-to-market losses of over $80 billion, according to data from S3 Partners. Guys, how many times have I told you be careful what you wish for? Why a lot of you are looking for the big crash. I've been looking for the big rallies, the big unexpected rallies. That's what hurts our enemies the most. The article continues. That's the biggest hit since January, when equity prices staged a surprisingly strong rebound from last year's rout. It's the latest blow for a group that's seen its bearish bets repeatedly upended in 2023 as the stock market defied naysayers, climbing sharply even as the Fed Reserve pushed up interest rates. For most of this year, the gains were fueled by an economy that remained unexpectedly resilient and by advances in artificial intelligence that set off a tech stock frenzy. Then, after the Fed on November 1st held interest rates steady for a second straight meeting, share prices started surging again amid conviction that its most aggressive monetary policy tightening since the 1980s is finally over. Quote, the shorts had to cover so quickly, it's almost like they didn't know what hit them, according to Quincy Crosby, chief global strategist at LPL Financial. The drubbing has left short sellers with paper losses of $106 billion this year, a big reversal of fortunes after they gained nearly $300 billion during the 2022 rout, according to S3. The recent rally may have gained support from short sellers who bought shares to close out money-losing positions. Quote, short covering is how you get a good, broad-based market rally going, said Louis Navellier, founder and chief investment officer of Navellier & Associates. Short bets against tech stocks were hit hardest. Information technology and consumer discretionary were the worst performing sectors on the short side in November, with Tesla, Apple, and Nvidia leading mark-to-market losses among shorts as they posted outsized gains. But the lingering risk of a recession appears to have emboldened some bets against the stock market by those who think it has run up too far. Okay, you know what? Bring the recession on. AMC, all movie theaters do great during recessions. Okay, Ihor, the managing director of predictive analytics over at S3, said the volume of open short positions rose to about 940 billion by November 30th from 838 billion on November 2nd. Quote, we see shares shorted increasing and mark-to-market value of the shorted securities increasing, he said. Shorts are increasing their positions even if the market is going against them. So guys, we're what's left and they're doubling down. So what happened on Monday? Stock market news today, stocks slip as rally takes breather. Stock rally fades as Wall Street gets a reality check, right? S&P 500 down 24.85. Dow down 41 points. NASDAQ down 119. But what's this? Russell 2000 up 1%? What's that about, guys? Now, guys, do you remember this article from November 15th, Zero Hedge? I've used it in 4 videos so far. Russell 2000 call volumes explode to all-time high in short crushing ripfest. Realizing they are far too short the Russell to cover cash single names and go long, hedge funds did the next best thing they could. Bought a shitload of IWM calls, and then bought even more calls. Let me translate that for you guys. They were so short, the individual names, the small caps within the Russell, they couldn't cover. So they did the only thing they could do. They hedged. And they hedged so much, they set a record. Now add that to this headline and this chart. Single stock short selling. Hedge funds, U.S. single stock short flows increasing for a record 14 consecutive weeks, according to Goldman Sachs. Now you guys wonder why I keep saying, hey, these people are desperate for a sell-off, a real correction, and it's the rallies that have been hurting them. And then today from MarketWatch, Wall Street dash for trash is heating up as small caps, unprofitable tech, and other speculative bets rally. Who's mentioned in the article? AMC and GME. From the article, a mad rush for small cap stocks, shares of unprofitable tech companies, and heavily shorted names have revived talk of a dash for trash on Wall Street. Talk of a migration from quality to trash has reemerged as investors begin to shun the S&P 500 SPX in favor of riskier, more speculative bets. No mention of short covering, okay? But let's just call this entire sector trash. That's because it's rallying. Okay, now guys, you're not going to see this on CNBC or Fox Business. I doubt it. And the only reason Bloomberg is publishing it is because the Bank for International Settlements, or the BIS, published a paper. Headline, Margin Calls from Clearinghouses Seen Stoking Future Crises. Use of central clearing was seen as a fix after 2008 crisis. BIS researchers see a liquidity risk from margin spirals. Yeah, think of the liquidity fairy. Anyway, from the article, I won't read the whole thing to you, but I suggest you read it yourself. I'm just going to give you some excerpts. Central clearinghouses that hold over $1 trillion in liquid assets may exacerbate periods of financial stress, creating margin spirals that can push down asset prices, according to researchers from the Bank for International Settlements. The researchers focused on the impact when the central counterparty clearinghouses, known as CCPs, increase initial margin requirements for its members during times of stress. This may lead to fire sales in cash and derivative markets as investors dump assets to raise the needed funds, increasing volatility further and triggering additional rounds of margin calls, the paper notes. Settling transactions through central clearinghouses was one of the key objectives of market regulations following the global financial crisis that sought to vanquish the risk that the blow-up of one firm would cause a systemic shock like the one that followed the Lehman Brothers collapse. Even now, U.S. regulators are pushing for hedge funds. See, pick them right at the top to start centrally clearing many of their transactions in treasuries. The BIS also warned in a separate paper that liquidity needs may force some life insurers to recognize yet unrecognized losses in similar fashion to the U.S. banking turmoil in March. That's right. When these losses go from being an unrealized loss to a realized loss, many of these banks instantly start failing their stress tests. And is Uncle Frank worried? Hell no. I've been rooting for this crap for months. I own XRP and a theater stock that's shorted 4 times over. Why would I worry? They need to be worried. I'm excited about this tweet from KevDoggy32 about our retail popcorn. Boom! AMC Popcorn has finally arrived at Publix in Tampa. Yes, I will certainly be supporting my company/investment tonight. Glad to hear it, Kev. You see, guys, when you have 106 billion in paper losses this year, and there may be billions of synthetic shares out there that ultimately must be accounted for and reconciled, when you're leveraged 56 to 1, and the Bank for International Settlements is writing research papers about you and warning about margin calls and margin spirals, when you're short so much that you can't cover even if you tried, and the only thing you could do is hedge, you need to be worried. I'm not worried about a thing. Instead, I'm going to talk about how good my theater and our new distribution business is doing. From Vibe, Beyonce Renaissance Film ranks #1, brings in highest December debut in 20 years. From the article, during opening weekend in North America, the concert film, which Bey wrote, directed, produced, and starred in, brought in the biggest December opening in 2 decades, according to The Hollywood Reporter. Quote, better than expected, it grossed $21 million domestically, along with a perfect 100% Rotten Tomatoes score and glowing reviews. And more good news for the hedgies. From the street, stocks are poised for a big 2024 rally, even if the Fed doesn't cut rates. Now do you guys see why Uncle Frank roots for white swans? Because our white swan is a black swan for the predatory short hedge funds. All in all, Amy and the rest of the trash, as they like to call the small caps, had a good day. By the way, we wouldn't be a small cap if it wasn't for that reverse split Adam shoved down our throats. Amy closed at $7.49, up 63 cents or 9.18%. At the time of this recording, I've got Max Payne at 7 and the put-call ratio at 0.2725. Based on that last price of $7.49, expect support to the downside at levels 702, 655, and 629. Expect resistance to the upside at points 775, 801, and 848. Everyone that writes hit pieces against AMC loves to talk about our debt, but I want to talk about this chart before I'm off to bed to sleep like a baby. I wanted my last slide to be about unrealized losses that may become realized losses very, very soon. From Schiff Gold, unrealized gains and unrealized losses on securities at commercial banks in the billions. You see that's negative there. You see that red part? You see, I think they should be worried about this and not so much about my debt. From the article, unrealized losses, primarily on U.S. Treasuries and mortgage-backed securities, rose by $126 billion in Q3 and now total $684 billion, according to the FDIC's quarterly bank data release. It's important to understand that these are only paper losses. Ostensibly, the banks will hold these bonds until maturity and then will be paid their face value. If it plays out this way, there won't be any real losses. The problem is these unrealized losses drastically decrease a bank's liquidity. If it has to sell bonds in order to raise capital, the bank will experience significant losses. That is exactly what took down Silicon Valley Bank last March. Sleep tight. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.